It is that time of the year last week, and we have two excellent fund managers lined up for you to give us a peep into the year that will be, that is Outlook 2025. Joining me first is Mr. S Naren, the CIO of ICICI Prudential Mutual Fund, and thereafter we will be joined by Samir Arora, the fund manager from Helios Mutual Fund. But first, Naren, thank you very much indeed for joining us. It's really auspicious that we have you to guide us on how 2025 will pan out.
Pleasure to, very happy 2025 to all the viewers and to all of you.
Thank you very much. Fund managers like you can make all the difference actually to whether it's a happy or a not so happy 2025.
I think it's the markets which do it. It's the markets which do it. Fund managers do it less than the markets, in my opinion.
That's an extremely humble way to start, Naren. But okay, this year, the Nifty at one point, we thought we would run away with a 20% gain. But okay, at 13.5%, 14% this year is a fairly decent one. Small caps, for all the abuse thrown at them and fears that we had, is still ending the year with close to 30%. How does 2025 at the outset look to you?
Actually, there were 3-4 years, when we always used to say consumers look overvalued and it'll underperform, and it kept outperforming. Now, for the last 2 years, we are the butt of jokes, people saying you are always cautious on mid caps and small caps and mid caps keep outperforming. So I think what has really happened is that you have a situation where the only seller in the market is the FII. And FIIs keep selling only large caps. So the small and mid caps are the biggest outperformers in the market all the way from 2021. So the small caps and mid caps have clearly become much more overvalued, but they never fall because the FIIs are only selling large caps. And that has been the situation all the way from 2021 onwards, that we are the butt of jokes in this entire segment. That at all points of time, ICICI Prudential is cautious on mid caps and small caps, but mid caps and small caps always outperform large caps.
No, actually, there will be many like you and many investors as well who repose faith in you simply because of the safety of that argument. So I wouldn't decry it as much as you are. But how will 2025 pan out in terms of this US exceptionalism, which is what drew away all the FII money or much of it? Does this exceptionalism continue? After all, US growth rates are good, and the Trump trade has worked for that country. Do you think 2025 also will continue to see FII drawdowns?
See, this exceptionalism cannot continue forever because all said and done, India's growth rate is much higher than US and will continue to be, because structurally India's growth is much better than that of US. So I do not think it can continue forever. Can it continue for a few quarters? Yes, it's possible, but it won't last for a long period of time. Because if you look at India's macro, it is in very good shape. If you look at current account deficit or fiscal deficit or inflation and compare where we are at this point of time, we are in very good shape. So I don't think it can go on forever. So I think at some point of time, FIIs are likely to come back into the country, and that too into large caps. But the real problem at this point of time is that the domestic investor sees equity as a riskless asset and has been investing. If you look at the number of loss-making companies that the domestic investor is comfortable investing into, that whether that at some point of time will change is the question that we don't have answer. At that point of time, there can be a problem because investors are not looking at valuation. Domestic investors are not looking at valuation. The foreign investor is saying, I want my money back in US at any cost, in dollars at any cost. So they've been taking out money. But the domestic investor is possibly not risk averse at all. And for the last 10 years, we have not had a down year. So people perceive that equities is a riskless asset, which it is not.
Yeah. I mean, shares must rise for earnings and not for flows. That's the fundamental lesson we have learned for the last 2-3 decades, haven't we? You can't buy a stock because others are buying it. But Naren, there is also one level of skepticism with the domestic market, especially after the recent numbers. We first thought, okay, the Q2 earnings are bad because of base effect, value, margins. There were a whole lot of other reasons. Then we got the shock of this Q2 GDP number going down. And now we have the CA also saying that if you guys don't pay enough, then there will not be enough consumption. Do you really worry about the consumption aspect of India, and will that cast a shadow on the way you pick stocks?
We don't worry so much about all these things because finally, at the end of the day, the growth is very much there. Look at some of the areas, look at airline passenger growth or hotel tariffs or something like that. You can look at those areas and be very positive on India. Even if you look at two-wheeler growth this year, I think it has been very good at this point of time. So I don't think really we are worried about growth. We've been worried about valuations and not growth and fundamentals, and the fact that people are not discriminating. So if you look at it, that is the bigger challenge we've been worried about. We have not been worried about growth at this point of time per se, and how all these numbers are calculated is also a challenge actually. So if you look at look at the last quarter numbers, I mean, some of the oil marketing companies moved from a very different number 1 year back to where it is at this point of time.
Yeah.
That also affected the earnings. So you look at banking earnings. Banking is one of the most important indicators of economy. I think those numbers were very good. So isn't banking earnings more important than oil marketing companies? That's how we look at it. So I don't think we are really worried about growth or something like that. We have always been worried about valuations. We are worried about the fact that investor risk appetite domestically is very high and globally for India is not high. It is very low.
Fair enough. Let's discuss the domestic themes in that case. You came up with some examples. If you look at airlines and if you look at hotels, Indian consumption looks very good. So would discretionaries be a good theme? And would FMCG or any kind of mass consumption not be your favorites?
See, basically, we are by nature contrarian. So what we do is we try to see where people are very not so positive. So, by nature, we like areas like rural or, quality stocks or things like that, where things have been negative for quite some time. And therefore, there's opportunity for the future. Whereas we are more negative on things which have done very, very well. If you look at hotel stocks at this point of time, look at the fire CAGR in hotel stocks, it is outstanding from 2020 to 24. So by nature, we believe that some of the very good news gets priced into equities, but that's the nature of the equity market. Whereas if you look at some of the rural areas, stocks like FMCG and all that, we used to be very negative on FMCG, but over the next few years, maybe FMCG kind of areas, maybe the areas to invest in. And cement could be another area to invest in because these are the areas like mid-cap cement or FMCG and those kind of sectors could be the areas actually where you should invest in because the maximum pessimism areas are always the best areas to invest in. Like in 2020, it used to be metals, telecom, PSU, etc. Today, it could be something else at this point.
Oh, fair point. That's sane advice, actually, for those who may be shunning these sectors because of this narrative of lower urban consumption. What should be the other themes that you will look at? Will you look at EMS? Will you look at e-commerce? Train our eyes to other such sectors.
You are telling me all the areas. EMS is the other area where the P itself is more than 200, 300.
Absolutely. Absolutely.
No, for us, for example, in 2020, people used to tell us quality is the area which is most favored because they'll never go out of fashion. So the last 4 years, quality has been the area which has done the worst. So we like quality, we like rural, we like all these themes which have done badly and where we think from here on the outlook would be good. In 2020, we used to like all the opposite of these things. We used to like PSU, we used to like urban consumption. We used to like these sectors. So I would say that, finally cycles play out. There are cycles which are at the bottom. There are cycles which are at the top. We have to be careful in cycles which are at the top. If you look at EMS, today it is just like 2007 infra. Someone signs an agreement today for the next 10 years. Profits are already priced into the stock on that day. That's the way the sector behaves. And we have seen from our experience of 2007 infra, there is a lot of things which go wrong 5 years after the contract is signed. So that's why we are much more.
Okay. Well, I've used up all my time asking you about equities, but tell us about asset allocation. I mean, would you take a good look at, say, corporate bonds, fixed income, gold? What would be your asset allocation strategy?
We are very fond of multi-asset because it gives you opportunities in REITs. We have been very positive on REITs. We think that we like the entire office space, for example. We like corporate bonds, for example. But the best way to do it is through hybrid funds at this point of time. So, over the last few years, we've been trying our best to get money into hybrid funds because people are just not willing to invest in debt funds. So we thought at least the way to get money in debt funds, debt is through investing in hybrid funds. A particular area is multi-asset because that's the way you can get investments even in REITs, InvITs, exchange-traded commodity derivatives. For example, gold and silver, you would have never got money easily, but through the multi-asset route, we managed to get a lot of money invested in gold and silver in our funds. And luckily, thanks to the good work done by the mutual fund distributors and investors, we managed to make our multi-asset fund a very large fund thanks to the work done by them.
You know, that's a very valuable lesson you're giving our viewers, that multi-asset funds is a concept whose time has come, and there are very good reasons why we should be participating in those. Thanks a lot for all that advice, Naren. Here's wishing you once again a happy 2025. We need to go into a break, and thereafter we'll be joined by Samir Arora, the fund manager from Helios Capital. Welcome back to our year-end series, Outlook 2025. And we now have a delightfully intelligent fund manager and veteran stock market watcher, Samir Arora, founder, of course, of Helios Capital. Samir, good morning, and thank you very much indeed for sparing time for us.
I have to come here to cheer you guys up.
Well, we need some cheering. You know, at one point in time around October, we thought we were going to run away with a 20% gain on the index, or probably even more. It's been, shaved off to perhaps at best a 10% gain. What's your sense? Do we find the bottom quickly, or can we plumb some more depths before the market rises?
So actually, Nifty is up 10 and the 500 index is up 15. So that's why I feel that it is not in any way some out of line kind of returns. But let's see the guys, because I am positive. Of course, the degree of positivity in terms of how much returns you can make will be obviously less than what we made in the last 2-3 years. But let's do first big picture. So the world, and we have these guys in the US talking about the biggest bubble in US. So if you look at the US market, if you look at the equal weight index or the Russell 2000 index, for the last 5 years, these returns will be something like 10% per annum. So basically, when people talk about US having a big bull run, they are talking about 10 to 15 stocks.
Okay.
And on those 10, 15 stocks, including the Magnificent Seven and a few others you can add, all of them separately, they are cash rich, big beneficiaries of AI, not concept stocks. Their valuations are in 20s and 30s. And for the US stock to have guidance or expected consensus earnings growth of 15% type, from, you look at Amazon, you look at Google, you look at Microsoft, all of them, at least as of now, expected to grow earnings at 15%. So what is so wrong about those guys also having premier valuations a little bit, but having gone up a lot and still trading in 20s and 30s multiple with a 15% type of growth? So I don't feel that the US market itself is a bubble just by looking at S&P, which is driven by these 15 stocks. And if the US market is not a bubble, the first part of the argument goes away that this world is in some mad bull run. And if you look at India, the Indian market returns for the last 3 years for the index, which is not even, let's take Nifty, because clearly Nifty has done poorly. But if you do even the 500 index for 3 years, it'll be up around 15% per annum,
Okay.
which is more or less in line with our longer term history. And now let us say that somebody thinks it's overvalued because the earnings were a bit slow in this quarter and last quarter, and therefore the fair value is 19 times PE, but you are at 21 times PE. So you are overvalued by 10-15%, which you have accumulated over 2-3 years. Who is to say that the market is always supposed to trade at whatever is your longer term average? And secondly, that the correction has to happen in one stroke, so that first it has to correct 10%, 12%, and then it'll become a good market. Maybe it corrects gradually, maybe it goes up first and then goes down. It is not wildly out of line. I have seen
Fair enough.
wildly out of line markets. For example, in 2004, 5, 6, and 7 calendar years, the market was up 40% per annum. If you look at the 500 index, it was up some 39 point some percent per annum. We have seen periods like 1999 when the market went up some 85% and the NAV of my fund, Alliance Equity Fund, now called Birla Sun Life Equity Fund, in that one calendar year was up 280%. Those are wild bull runs. This is a measured bull run according to me.
No, I remember those times. Cub reporter, but I have interviewed you in Alliance as well, Samir. But when we are stepping into the coming year, do you think we will still continue, or fund managers should be chasing, the EMS or the e-commerce, the new gen stocks? What has been ignored? The HDFC banks, Reliance, TCS, those were the ones that the market's not been looking at. Will
No,
things
first
turn?
of all, then we talk about market. First, we talk about the market is 500 index.
Yes,
So
of
the
course.
question whether the market will go up or not is not whether Dixon will go up another 100%. Most probably it won't. And neither will my food companies go up 100%. But can they go up slightly more than that? So before that, the market itself will have some rotation in a sense that obviously because the large caps have massively underperformed mid and small. And in the past, if you do before this round of bull run of mid and small in 2020, so if you look at previous 20 years ending in 2019 December, let's say, which I did, broadly the large caps and small caps and mid caps are not materially different from each other. The small caps actually in a big 20-year type phase actually underperformed even the 500 index. Means broadly they converge. Similarly, in the US, they converge, except that in the last 6, 7 years, 5 years, there the opposite has happened. That the large caps, particularly these big 20-odd companies, have done much better. But again, there in the past, they converge. So therefore, first we have to say that whether next year is a year for which we have to be bearish and sitting on cash and waiting for a crash, I think that is not obvious and not needed. But therefore, the market returns, if the market returns are expected, according to us, to be in the same range as our historical longer term average, which is 12-14%. Then these stocks which are growing 10, 12, 14% with a higher confidence, like these banks and all you're saying, become better candidates. And that's why not me only, many of the guys even...
No, I got that. Yeah, so what will you rotate into is my question. One of them you picked up, one of them you would rotate into would be banks. What else would you rotate into and rotate out of? Okay.
We never rotated out of them. So our logic is that you will have 2 or 3 main chunks, which mostly the market has converged to financial sector, financial services, private sector banks, and some form of IT, which for 2 years we were bearish up to June of 24, and now we think IT is a good sector. And then you need a bit of jing bang. You need a bit of dreams and this thing where you can grow at least the earnings at 30% and 25% for 3-4 years, hopefully. And that some people this year chose EMS and we chose the food delivery and the new platform type companies, which are, these ATM and PB Fintech and Swiggy and Zomato and car trade and all, where you're hoping that there are some longer term, tailwinds, so that at least for the next few years, 3-4 years, you're not growing at 15%, 12%, which is what our boring banks and even IT might grow in that range. which is this 12, 14%,
Got it.
15% type range. So you need a jing bank. So that is why it's called a portfolio.
Got that.
We will not buy the EMS companies because our logic is that we have a benchmark, and those benchmarks of EMS companies trade at 8 multiple and 10 multiple. And in India, you can make it 20 because everything is double, but you don't make it 150 multiple.
Okay, fair point. Well, just one more word on consumption. This year has been the year for the discretionary consumption, the Trents, the Indian hotels, the Titans, and it's not been for the FMCGs. Will things continue that way, or will the tables turn?
Actually, it's not been for Titan also, because we sold it about 9, 10, 12 months ago, because I watch Netflix and I could see that there was this documentary on lab-grown diamonds, which has now become a hot thing, going on for long. And this is where you made more money. And more than that, it spoils the whole thing of buying diamonds if you can't distinguish, even though technically somebody might know this is a real diamond or a lab-grown or whatever. But in general, I think what our basic concept is that very high valuations can be a stumbling block, even though the companies may grow. So we don't have these kind of consumer companies. We have a few of these Zomato type, which also you can say high valuation if you so desire. But their growth rates will be very high compared to the rest for a number of years.
Okay. Samir, you are also a global fund manager. So tell us, do you think US exceptionalism goes away? Do you think smart money will come back to EMs and India?
No, smart money should buy both. I, after the Trump victory, bought all the 4 asset classes personally, because in my fund I only broadly do India, and then we have a global fund. But that is India, US, China, and gold. Everything is a buy. First of all, please remember, we've not had a blowout rally. We've not had that last thing where markets go up 20, 30% in a 2, 3, 4 month period. And by the way, you can see all these previous bull runs that people talk about, and then they say that they sat on cash. So let's say the 91 bull run, Harshad Mehta time, boom, it'll go up some 80, 90% in a few months, and then it'll crash. Same thing happened in 99, 2000, where in the last part of 99 and first 2, 3 months of 2000, the market would have gone up, or these tech stocks would have gone up 100% kind.
Right.
And even in 2007, 8, because I know my NAV, my hedge fund NAV went up 104%. Okay. This year and this period has not been like that. It has been very measured. And the reason why it is measured is that there is supply. Now, people take it as a negative that there has been so much supply. But simultaneously, there has been so much demand in the sense of flows from domestic guys. But whatever be the reason, the supply has made the overall market in check. So the overall market has not gone up, maybe other than 10, 15 stocks, in which we have also become negative on a few of them, and we have a few. Every portfolio manager will have 2, 3 such stocks with a combined weight of 7, 8%. Or somebody can have Trent and something, I will have Zomato and something, somebody will have Dixon and something, but it's not driving madness in our portfolios or in the hype in the market.
Got it. Samir, out of time, and here's wishing that you have a superb 2025. Thank you very much indeed for joining us.
Thank you very much. Be bullish.
Oh yes, be bullish. Advice taken. Thank you very much, Samir Arora, for joining us in this year-ender. And here's wishing all of you once again a happy 2025.